All right, everybody, welcome back. We're going to get into our first major category, taxes, property taxes. Again, I mentioned earlier that in the earlier module that this is probably the biggest mistake I see that is made when we're underwriting a deal, certainly by far. It's important to know what the current property taxes are. But what's even more important are the property taxes that you're going to pay on the new purchase price. So one of the things you're going to look at is you're going to contact the county. And sometimes the broker will have the millage rate written into their OM. The millage rate is a rate that's used by the county to calculate the taxes for the properties in the area. So, and every county, even within counties, depending upon where the apartment is located, has different millage rates, even within the same county. So it's really pretty much address specific. And so one way to calculate taxes from 30,000 feet, when we're looking at a really high level, is take the purchase price times 80% and then times the millage rate. So if you're buying an apartment for, say, $1 million, 80% of that would be $800,000 times the millage rate to get your taxes. It can be that simple. But sometimes it's not that simple because different states have different ways that they will configure their property taxes. And for example, I think I may have mentioned earlier that where we own property in South Carolina, they actually take the new purchase price and they take the purchase price times 6%, and then they take that 6% and then they factor in their millage rate, and that's what you use to calculate your new taxes. Many of the states are called what's called a point of sale state, which means at the point of sale when you buy the property, that the new taxes immediately begin to accumulate. And it's important for you to know that number because the lender is going to calculate that out. And in most cases, in these loans, the lender is going to be collecting in advance the property taxes, which is going to take income away on a monthly basis from your actual income that on your bottom line every single month. Lenders usually take the property taxes and put it in a reserve, and also the insurance number, and they'll put it in a reserve because these are two of the larger expenses that's paid once a year, and so they want to make sure to prevent the property from going into a default that they have the money, they call it in escrow. They'll hold the money in escrow. So you want to be really careful and make sure that you understand and you actually know how to calculate the property tax. And the only way to do that is that if you don't know and you're not familiar, you have to call the county where you're buying the property. Get them on the phone, tell them you're getting ready to buy, you're interested in making an offer on a property. This is approximately the purchase price. Can you please share with me how to calculate the taxes? Or you can send them an email. In some counties, I just did that with a particular piece of property that I'm looking at in another state. So, but you want to make sure that you can explain to somebody how the taxes were calculated so that you know. And once you know how to do it in that state, it's the same. The only thing that changes, again, is the millage rate in where the property is located. Now, some states, the property will be reassessed, and sometimes it doesn't happen every year. For example, in North Carolina, where we actually own some property, it's done once every 7 years. Even though the state law says that the appraiser can appraise every year, it's typically done, and it's pretty consistent every 7 years. Obviously, this will affect your cash flow, and in some places and in some states, they don't publicize the price of the property, so the appraiser has to go through, particularly in a state like Texas where they don't list the purchase price of the property as public information. They go through a number of third parties and different ways that they have to create what they think is the property value. Now, we own property, a property in Texas, an office building, and we just got assessed. And the way that the county did it, we had to submit some paperwork to them, and at the end of the day, what happened is that they calculated the millage rate on the entire purchase price. They don't even give us any discount for the land, because typically your taxes, your property taxes, are based on the building. They call it the improvement, and then they only tax the improvement and not the land. But in this particular area, they taxed it on the entire amount, which made our taxes a lot higher than what we projected. Thank goodness we projected a little bit higher, so it offset some of that negative amount of taxes that we had, additional taxes that we had to pay. So we're going to take a quick break here, and we're going to come back and talk about insurance in just a moment.